Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial on the web, as always, at elevationfinancial.com. Today we're talking SIPC insurance. Riveting topic, insurance. I know, I'm sure your eyes are glazing over already, but we're going to talk about what is SIPC insurance, what it is, and how it protects your brokerage account. So if you keep money in a bank, you're probably familiar with FDIC insurance. It's that guarantee that keeps your deposits safe up to $250,000, even if your bank fails. But what about money and investments in your brokerage account? That's where SIPC insurance comes in. The Securities Investor Protection Corporation, or SIPC, serves a similar protective role for investors. But most people have never heard of it, and many people don't understand how it works. So it matters more than you might think. So we're going to talk through SIPC insurance, what it means, and how it works. So what is SIPC insurance? SIPC stands for Securities Investor Protection Corporation. It's a nonprofit organization created by Congress in 1970 to protect investors when brokerage firms fail. So think of it as a safety net. If your brokerage firm goes bankrupt or closes its doors, SIPC steps in to help recover your securities and your cash. SIPC isn't a government agency, though it operates under federal oversight. It's funded by its member brokerage firms, not taxpayer dollars. Nearly all registered broker-dealers in the United States are required to be SIPC members. The organization maintains a fund that currently exceeds $4 billion, and the fund is used to reimburse investors when member firms fail and customer assets go missing. So how does SIPC protection work? So here's the important part. SIPC doesn't protect you from losing money on bad investments. It protects you from losing your securities if a brokerage firm fails. So it's a big difference. So when a brokerage firm collapses, SIPC works to return your actual securities to you. If you own 100 shares of Apple stock, for example, through that firm, SIPC's goal is to get those 100 shares back to you or transfer them to another brokerage. Sometimes those securities go missing. Maybe the brokerage engaged in fraud or mismanaged customer accounts. And in these cases, SIPC insurance kicks in to compensate you for those losses. So it typically works like this. When an SIPC member firm fails, SIPC either works with another firm to transfer customer accounts or initiates a formal liquidation process in federal court. A trustee is appointed to oversee the recovery and the distribution of customer assets. Most of the time, customer securities are identifiable, can be returned directly. But when assets are missing or the firm's records are incomplete, that's when the coverage becomes even more important. So let's talk about coverage limits. How much protection do you actually get? So SIPC provides protection of up to $500,000 per customer per brokerage firm. And within that, total cash claims are limited to $250,000. So let's break that down with some examples. So let's say you have a brokerage account with $600,000 worth of stocks and $50,000 in cash. If your firm fails and your assets go missing, SIPC would cover up to $500,000 of your securities and up to $250,000 of your cash. So in this scenario, you'd be fully protected since your cash falls within the limit, but you'd potentially lose $100,000 worth of securities because it exceeds that $500,000 cap. So let's say you have $200,000 in stocks and $300,000 in cash. SIPC would cover all $200,000 of your securities, but only up to $250,000 of your cash. So you'd have a $50,000 loss on the excess cash. So the $500,000 per customer rule includes an important detail. It's based on separate customer capacities. And what that means is if you have multiple account types at the same firm, each might qualify for separate coverage. So for example, let's say you have an individual account, a joint account with your spouse, and an IRA. Each of these could potentially receive separate SIPC coverage of up to $500,000 because they represent different legal capacities. So that's similar to how FDIC insurance works at banks. Different account ownership structures receive separate coverage. So what does SIPC insurance cover? So the protection applies to most types of securities held in your brokerage account. So these are things like stocks, bonds, treasuries, certificates of deposit, mutual funds and ETFs, and money market mutual funds. So these are the core holdings that are going to be in most investment accounts. You're going to see these by and large as the general holdings in most investment accounts. So SIPC also covers certain notes, certain investment contracts, and other securities registered with the Securities and Exchange Commission. And that protection extends to both cash and securities. So the cash sitting in your brokerage account waiting to be invested is covered up to that $250,000 limit. So one important point, once again, SIPC insurance protects the securities themselves, not their market value at any particular time. So if you owned 50 shares of a stock when your brokerage failed, SIPC works to return those 50 shares to you. It doesn't matter if the stock price has dropped since you bought it. And that leads us to reiterating this important point. What does SIPC insurance not cover? So first and foremost, SIPC does not protect you from investment losses. Really important point. If you buy a stock and it loses value, SIPC won't reimburse you. That's investment risk, not brokerage failure risk. SIPC also doesn't cover certain types of investments, things like commodity futures contracts, currency, limited partnerships. Certain types of investments are not covered. Precious metals held in certificate form are also not covered. If you have gold or silver certificates through your brokerage, SIPC does not cover those. Cases of fraud by brokers who offer investment advice but aren't authorized to hold customer funds typically fall outside SIPC protection. And the same goes for losses from unauthorized trading in your account, although you may have other legal remedies for that. SIPC doesn't cover losses from market manipulation or other illegal activities that affect security prices across the market. Again, it's not about protecting market conditions. It's about protecting your holdings from brokerage failure. That's the important point. So how does SIPC differ from FDIC insurance? So many people confuse the two, but they serve a different purpose. So once again, FDIC insurance protects bank deposits. When a bank fails, FDIC guarantees you'll get your money back up to $250,000 per depositor, per bank, per ownership category. You're getting those dollars back. It's very simple. SIPC protects brokerage accounts. When a brokerage fails, SIPC works to return your securities to you. The coverage limit is higher, which is $500,000 or $250,000 for the cash in those accounts, but the goal is different. SIPC is focused on returning your actual investments, not just the cash. So another key difference is that FDIC insurance protects you from losing the value of your deposits. SIPC protects you from losing the securities themselves due to brokerage failure, but not from market losses. So both offer important protections, just in different contexts. So if you're keeping large amounts of cash on hand, a bank with FDIC insurance might make sense. For investing, an SIPC member brokerage provides the right protection. So you got to kind of look at each one, see what's appropriate for you. So let's talk about excess SIPC insurance. So many large brokerage firms carry additional private insurance beyond the standard SIPC coverage. This is sometimes called excess SIPC insurance or supplemental coverage. So large firms, for example, Fidelity, Vanguard, Schwab, Altruist, others typically offer coverage well beyond the standard SIPC limits. Some provide protection in the tens of millions of dollars per account. So you have to look at each one individually. So this coverage works in conjunction with SIPC protection. If SIPC's coverage is exhausted, the supplemental policy kicks in to provide additional protection. So before you assume this coverage is there, check with your brokerage firm. Not all firms carry it, and the specific terms vary. So your firm's website should have details about their insurance coverage, or you can contact their customer service and ask them about it. So for most investors, or for many investors, I should say, SIPC coverage is sufficient, but if you're holding significantly more than $500,000 at a single brokerage firm, excess coverage is worth looking into. So how do you verify that your brokerage has SIPC protection? So it's pretty straightforward. Visit the SIPC's website at sipc.org and use their member search tool. You can search by firm name to verify membership status. You can also look for SIPC membership disclosures on your firm's website or account statements. Member firms are required to display their membership status. If you're considering opening an account with a new brokerage, checking SIPC membership should be part of your due diligence. And honestly, virtually all established broker-dealers are members, but it's worth confirming. So be cautious with offshore brokerages or firms that aren't registered with U.S. regulators. These typically may not have SIPC protection, and that could add a lot of risk to your investments. So let's talk about strategies for maximizing your protection. So if you have a lot of assets spread across multiple brokerage firms, that can increase your total protection because each firm offers separate coverage of up to $500,000. So for example, if you have $1.5 million to invest, you could place $500,000 at 3 different SIPC member firms. And that way, all of your assets would be within the SIPC limits. Within a single firm, you could use different account types as well. Remember that individual accounts, joint accounts, retirement accounts, and trust accounts each receive separate structure or separate coverage because they represent different ownership structures. So a couple might have individual accounts at $500,000 in coverage each, a joint account at $500,000 in coverage, and IRAs, which offer $500,000 in coverage each. That's potentially up to $2.5 million in SIPC coverage at a single firm across different account types. So keep detailed records of your holdings, keep statements, keep records. In the unlikely event of a brokerage failure, having your own documentation can really help with the recovery process. And consider firms with excess SIPC coverage if you're maintaining large balances. And again, virtually all major mainstream brokerage firms have excess protection, but again, worth looking into. So what is SIPC's track record? So since its creation in 1970, SIPC has helped recover funds in more than 300 brokerage failure cases. They've returned over $140 billion in assets to investors. Most SIPC cases are resolved relatively quickly. In straightforward situations where securities can be easily identified and transferred, the process might only take a few months. So complex cases, which involve fraud or missing assets, those can take longer. Some high-profile cases like the Bernie Madoff Ponzi scheme can take years to fully resolve. However, SIPC sometimes and often can make advance payments to eligible customers while the case continues. The success rate for recovery is pretty high. In the vast majority of cases, investors receive their securities or cash back, either through direct return of assets or through SIPC insurance payouts. And honestly, brokerage failures are pretty rare. The U.S. securities industry is heavily regulated, and most firms maintain strong financial positions. But still, when failures do occur, SIPC provides that protection. So what happens if your brokerage fails? You'll receive notification from SIPC or the court-appointed trustee, and that notification will explain the process and your rights as a customer. The trustee works to identify and recover customer assets, and in many cases, your securities will simply be transferred to another brokerage firm. And you might be asked to choose which firm you'd like to transfer to. If assets are missing, you'll need to file a claim with the trustee, and the claim should detail what you owned at the firm, supported by your own records and statements. SIPC will review claims and determine coverage amounts. If your claims fall within SIPC limits and is approved, you'll receive either your securities back or compensation for the missing assets. And the entire process is overseen by federal court to ensure fairness and proper handling of customer assets. So I'm sure this would be stressful if this happens, but the system is designed to protect investors and recover as much as possible. So bottom line, SIPC insurance is important protection in your brokerage account. It's not a guarantee against investment losses, but it does protect you if your brokerage firm fails. Again, not if your investments decline in value, but if your brokerage account or brokerage firm fails. So that helps you make informed decisions about how you structure your investments, verifying your brokerage firm is an SIPC member, possibly verifying supplemental coverage, and should incentivize you as well to keep good records of your holdings, things like account statements and other documentation. So investing in the market involves financial risk, and that just comes with the territory. But with SIPC protection, you can at least reduce the risk that comes from the unlikely event of brokerage firm failures. So that's how it works. And I hope that's been helpful in kind of digging deep into the protections offered by SIPC insurance. All right, with that, as always, if you have questions, you can find me at elevationfinancial.com. You can find me on pretty much any social platform. You can send me a message through my website, or if you want to talk in real time and you want to maybe learn more about becoming a client, you can schedule a free consultation on my website as well. All right, everyone. Thanks for joining me today. Have a great day. See you next time.